My name is Corey, and I work with Investor Life. And in Investor Life, what we do is we help investors raise the capital they need through one way or another, using a letter of intent as one of them, so that you can scale your portfolio, buy as many properties as you want. Hey guys, welcome to our tutorial on using a document called a letter of intent. And this is a document that we use to literally raise millions of dollars, to raise capital so that we could purchase as much real estate as we wanted to purchase. And you can use it the same way too. And so in this tutorial, we're going to go through all of the points of the letter of intent. We're actually going to fill one out, and you're going to see the reasons why some of these questions are included in it and why we need to know the answers to some of these questions, or what the intentions, our intentions might be in this relationship with somebody else, and what their intentions might be. And we can kind of get those together on one sheet of paper, or in this case, our letter of intent that we're going to be going through is a 3-page letter of intent. If you don't have a copy yet, guys, there should be a link here down in the description. So just download that, print it off. So let's get into this. And I'm going to share my screen, and we're going to jump right into using the letter of intent. I filled out a few of the first fairly basic stuff here, which is, our date, who we might be filling this out with, what is his name, address, etc. And really, this first question here is something that brings you something you're going to need to think about right off the bat, and that is, who is this relationship between? Are you going to be investing yourself personally? Are you going to be using a corporation to do that? And the same thing with your potential joint venture partner, or the person that you're going into business with here. What legal entity are they going to be using? That's the first question that you're going to answer here. And so this just gives you a good feel for the fact that this document is going to help you figure out some of these things that maybe you never really thought of that you are going to need to figure out before you get to the process of actually going out and buying a property. And so that's really what this document is about. And a few main points that I want to bring out before we get into further detail with it. And number one, that this document is used as a conversation starter. So here's all of the different things we need to start thinking about if we're going to start working together. Okay. Once you're at the point where you have somebody that says, hey, why don't we buy something together? Why don't we do this together? How is that going to work? That's where this document comes in to clarify those details. So it can be a conversation starter, and it can help you to continue that conversation. Maybe you've had that conversation a few weeks ago, nothing's happened since, you're not sure where to go from here. Well, that's where you can say, hey, listen, let's get together. You can do that online, you can do that through email, or maybe in person, and let's fill this out so that we're on the same page. We both have clear intentions on what we're doing. That's why it's called a letter of intent. Number two, main point why this is a very valuable document is that it gives you an outline of the things that you need to talk about. So when you're having this discussion, you've started it and you're continuing it. Well, what do you talk about? What are some of the things that you need answers to? And it also helps you, point number three, get answers to some of the tough questions that might be difficult to ask. You don't want to come straight out and say, well, how much money do you have to invest? But by answering some of the questions in this letter of intent, you'll be able to determine what type of investment might fit that particular investor. So good points to keep in mind there. And fourthly, remember that you want to start thinking about some of these details that maybe you haven't even thought of yet. And that's another purpose as to why it is very beneficial. And just maybe a fifth tip that I'm going to throw in there is, remember that you don't need to fill it out in perfection. Every answer to every question has some leeway. Again, the purpose of this is just to figure out intention. It's not to nail down details that are set in stone. This is not a legal document that you can take somebody to court with and say, hey, you said this and you said that. This is used different than that. This is used to just determine intention of both parties. And so remember, you don't need to have every answer perfectly filled out. It's not like you're going to be held accountable for that, or your partner doesn't need to be held accountable for that either. the first section that we talk about are some of the details on that particular property. So maybe you've had the discussion, okay, well, let's go and buy something. Well, what does that property look like? What is it going to be priced at? So this is the first question in here is actually one that kind of helps you determine how much money does your particular investor have to invest. If you are talking about a $500,000 property, and in Canada, we need 20% down as an investor, you need a minimum of $100,000. So you can start feeling the waters here as to what type of price range we should be looking in. Maybe you've discussed that already. That's one of the first things that we're going to be talking about here. And also this first question is the timeline. Okay, so price range, let's say in this example, we're going to be saying 400,000 and to 500,000, a property somewhere in there. So we know that our investor is going to need $80,000 to $100,000 roughly, plus closing costs and those sorts of things. Property will be purchased within how many days from today? So let's say in this example, I'm going to say 4 months. We don't want to leave this for 5 years or 2 years or something like that. We want this to be as soon as possible. That's kind of the point of a letter of intent is let's get moving on this. Let's start actually doing something, start searching for properties. Let's get started right away. And that's kind of what you're trying to accomplish here. So don't leave that too long. I would say don't leave it longer than 6 months, but also don't say, hey, we want to have a property purchase in the next week, because that might be unrealistic as well. So you're getting an idea on timelines. You're getting an idea on price range. What kind of style of property? Are you wanting a single family home, a condo, a townhouse, a duplex, maybe a multi-family property or commercial type of property? What discussions have you had regarding the type of property you want to buy? So let's say in this example, we're going to say a house with a suite. So a suited house, something like that, a house with a suite. That's the style we're going to look for. And, just to make sure that our rents match up with the prices, it needs to be X number of square foot. In this example, we're going to look for stuff that's roughly 1,800 square feet or larger. And again, guys, you're going to see that some of these details aren't super, super important. If you find everything that fits here and it's only 1,500 square feet, that's okay. There's nothing wrong with that. You're just getting general guidelines is the purpose of this. We want to get something that's maybe 3 bedrooms or more, has 2 bathrooms or more. That's the type of property we're going to start searching for. And it's located in X province in Canada. Or you know what, I don't mind that province over there either. So, maybe we can start looking for properties in 2 different areas. That location might be 2 different towns. That might be 2 different countries, guys. So it can be used so many different ways. Maybe we're saying, well, I don't mind looking in Calgary, Alberta, or in Edmonton, Alberta. This can be used, again, just to facilitate that conversation as to what you guys might be looking for. So then we get to some tougher type questions that a lot of times we're afraid to ask if we're going to be the working partner and we're looking to raise capital. Well, how much are they able to contribute to this deal? And this is where we can start determining some of these important questions we need the answers to. So JV Partner B, of course, JV Partner B is the one that we are joint venturing with. So JV Partner B is going to contribute approximately, well, how do we figure out that number? Well, let's say we buy something on the high side of our estimate here of 500,000. Well, we need 100,000 down. We're going to need some closing costs. We might need to do some renovations. I'm not sure. So in this case, we're going to need, let's say, 100,000 for the down payment and another 20,000 to cover all of our extra costs. So JV Partner will contribute roughly $120,000 is what their initial contribution is going to be in this case. Okay, so now you're starting to put this down on paper. Are you comfortable, JV Partner B? Are you comfortable with that number contributing approximately $120,000 towards this investment? And you're going to get a yes, you're going to get a no, or I'm more comfortable if we kept it under 100,000, or oh yeah, that looks great. Maybe at that number we can do 2 or 3 of these types of investments. And you can get, depending on how they answer your questions, you can get a feel for the amount of properties you might buy with them or how much they have to contribute to the joint venture. And of course, it does mention in here, you see it says the amount will be dependent on the purchase price, the closing costs, the initial repairs. All these costs are considered the capital investment. JV partner A, so that would be me in this case, makes a commitment to conduct and oversee all business relating to the acquisition, the administration, the management, the final closing on the property in lieu of a financial contribution. So in this particular example, JV partner B will be putting in the funds, JV partner A will be doing the work. And that's the way a lot of these are done. Now, if the setup is different, maybe you're both contributing funds, maybe you're both doing some work, well, then you can make the changes as needed. So property ownership, how is the ownership going to look? Well, the way we've done most of our joint ventures was 50-50. So our JV partner A and B each in this case would end up getting 50% of share of the property ownership. Now, we've already kind of answered question number 4 up here a little bit earlier, when the property will be purchased within 4 months from today. But our target closing date, remember, when we start putting in offers, and then by the time we get our financing and our conditions removed and all of those sorts of things, when would be the perfect target date? Okay. When would be the perfect target date? Well, if let's say we're planning to do something in the next 4 months, on or before, what is that specific date? So today, guys, that I'm doing this video happens to be on April I think it's the 10th or the 11th, something like that. Let's see, April 11th, 2023. 4 months from now would be May, June, July, August 11th. So let's just say on or before August 15th, 2023. That's kind of our target date. We would love to have something close by then. Okay. Of course, you have a spot in the bottom of each of these pages to initial. Question number 5 is an important one. Who's qualifying for the financing on this particular property? Either you're both JV partner A or B will be applying and qualifying for financing jointly, or maybe one of the two partners is going to be applying and qualifying for financing. So who's putting in the money has been determined. Who's qualifying for the financing? In this case, I'm going to be asking for partner B, since they're putting in the money, to also be qualifying for the financing. Since I'm giving 50% of the ownership to them, they're responsible for the money. I'm responsible for the work. Where this form is helping us to determine what each of us are looking for in this relationship. The title on property, now that's generally answered by who is qualifying for the financing. So if partner B in this case is qualifying for the financing, well, the bank will automatically put them on title. They will need to be on title. That's kind of the general way that it's done. But how am I secured then since I'm not on title as JV partner A? How are my interests secured? Well, through an actual joint venture document, they'll be secured. So the title will be held in, let's say, JV partner. So let's go back. That is John Jones in this case. Name with a caveat on title registered in my company. Okay. So I will register a caveat with our JV agreement on title saying that I have an interest in this property as per the JV agreement. So that's how the title will be handled. Again, guys, if we don't know the answers to this, don't stress over it. Our lawyers, our realtors, people who do this on a regular basis can help us to answer a lot of these questions. But again, if we can start facilitating this conversation with our potential partners ahead of time, it just makes everything run so much smoother. How long are we going to hold this property for? In most cases that you would be having a relationship with a joint venture partner. Now, there's cases where you might do flips together. You might have short-term relationships. But in most cases, it's more of a long-term type of investment. So this can be changed, but both parties agree that this may be a long-term investment and agree to hold the property for a minimum of X number of years. So, in most cases, we found somewhere between that 3, 5, 7 year mark is where you start to see good mortgage pay down. You start to see equity appreciation. Your cash flow starts to increase because your rents have increased as well. And so, in this case, we've had the discussion. We want to hold it for a minimum of 3 years, or if the property is increased in value by 25%, let's say we bought it for $500,000. 25% increase on 500,000 is of 125. So it's now, when it hits that $625,000 range, well, we can start having that discussion. Well, now maybe this is the time to sell that property. It's gone up by 25%. And it's also agreed that the investment shouldn't last beyond X number of years. Maybe we all want to be out of this in the next 10 years for sure. So minimum 3, maximum 10, or if it goes up a certain amount, though, that's when these discussions as to maybe selling or refinancing, those sorts of things can start to occur. Okay, so now let's break down some of the main areas that you're going to make money on this property. And one of them is equity appreciation. And remember, we already answered earlier on what the ownership percentages would be. But that doesn't necessarily always translate to how the money is going to be divided. In a lot of cases, the ownership amount can just be used straight across the board for your equity appreciation, for your cash flow, for any other ways that you make money on this property. Or you can tend to make adjustments to those numbers as well. I'll give you an example. Is we had one joint venture partner that did not want cash flow, but wanted a higher percentage of equity appreciation. So in that case, even though we owned the property 50-50, we gave him 66% of the equity appreciation. He gave us 100% of the cash flow. We ended up splitting the mortgage pay down 50-50. Okay, so all of those different ways of making money in real estate can be separated if you want. For ease of filling this out, equity appreciation will be split according to the percentage split in ownership. And in this case, it's 50-50. So let's just fill that out as 50-50. Remember, guys, equity appreciation is where a property goes up in value. So we bought it at 500, it's now worth 625. And so that gain in equity, we're talking about how we're going to split that 125,000. Cash flow is a second way that we end up making money. And it's defined here as all property revenues less all property expenses. So pretty straightforward. What our cash flow is defined as. Any cash flow collected will be split according to the percentage split in ownership. If that's the case, we'll make an X here. Or maybe we split it up differently. In this case, we're just going to go 50-50 as we talked about earlier, same as our ownership. And that's how we're going to distribute it. The next question is, when are we going to distribute it? Remember, we have income every single month in the form of rent. We have expenses every single month in the form of a mortgage payment, taxes, insurance, etc. But that remaining amount, how are we going to distribute it? Is it going to accumulate in our bank account for, let's say, 3 months, 6 months, or a year, potentially till the end of the investment? Or is it going to be distributed during that period of time? So I would say in most cases, a yearly distribution would be fairly common. Sometimes it's distributed at the end of the investment, and sometimes it's distributed sooner. But in this case, just for simplicity's sake, let's use 1 year. We would end up circling year or highlighting that, however you want to do that. But we're going to do that distributed every year would be the discussion we're going to have in this case. Upon sale or refinance. Okay, so now this is clarifying an important point when it comes to joint venturing, guys, and that is that upon sale, JV Partner B will receive their initial financial contribution first. So if we refinance or we sell this property, remember we bought it for 500,000. In order to do that, they put in 120. We now go and sell it at 625. The first thing that happens is that they get their $120,000 back first. That's what it's saying is going to happen here. They get their money back first. Then any gains that have been made, so equity appreciation, cash flow, etc., any gains would be split according to the percentages agreed. So remember, the first thing that gets paid back is their money. After that, then these other things are split. Okay, so something important to note there that both understand. So when we go to sell that property, they get their money back. Then we split any gains. And remember, the cash flow might have been split along the way. Okay, so that the cash flow might have been split 50-50 along the way. So that doesn't become a part of the gains upon sale because, you know, it's been distributed. So that's more pointing towards the mortgage pay down or the equity appreciation at that point. Okay, and then you got a spot to sign, guys. JV Partner A, JV Partner B you sign it showing that this is your intention moving forward. And a lot of times this next section here, guys, is used because now in order to go out and actually put an offer on a property, you need to, in a lot of provinces, put down a deposit right away to show that you're serious about buying this property. It makes your offers look better. So since my JV partner B here is making the entire initial financial contribution, I'm not expecting them to write me a check for $120,000 right now, but I might want $10,000 right now, just so that if I find a good property, I have the money now to go and put the deposit down, give it to the realtor. The realtor's brokerage or the seller's brokerage would end up holding that in trust, depending on whether we move forward or not. And so we need the funds available. And so this is a spot where you can actually just say, hey, listen, this document, return it to me, my company, be your lawyer as well. And we're looking for, my company is going to hold the deposit because we're going to be the ones writing the check to the realtor's brokerage in order to hold a property when we find a good one, a deposit. And it's only used for the purposes described in this letter of intent. We're making that clear. We're also giving them a notice that, okay, the first 10,000 is now, but the remaining 120,000, the remaining amount of the initial financial contribution, as this form here says, will likely be required within 2 weeks of the closing date. Remember, we already put down what our ideal closing date is. They know this is within 4 months. They need access to those funds, hopefully within the next 4 months, because that's our intent. The amount of the initial deposit, we'll use a number here of $10,000. That's what we're going to put down. Could be 5,000, could be 25,000. It could be whatever you guys agree to. Check payable to my company. I'm going to hold it. And a lot of people might say, well, who's going to give you $10,000 to write a deposit check? Wouldn't that be written to a lawyer or to a realtor's brokerage or something like that instead? And the answer could be yes. But remember, hopefully by this point, you have a strong enough relationship with this person that they trust you enough to have you hold this deposit. You're moving forward. You're now spending your time going out, looking at properties, doing analysis, running the numbers, doing everything you need to do. You're doing the work side of it. This is their side of it that they're getting 50% for, and that is the contribution of the funds. And so it is totally normal as well for them to be writing you as a working partner a check so that when you do find that property, you are able to distribute that money as quickly as possible. Now, if you have a great relationship with a lawyer and the lawyer says, absolutely, have them write a check to us, we will hold that on your behalf. We will then write a check to your realtor when you find a property. If you're able to set that up, that might make them feel more comfortable. But again, that's a whole nother discussion. And you can put your lawyer's contact information in here so they know that you do have one, you do have a team built up. It will give them more confidence as well. And you can initial that page as well. Okay, guys, so then this is our filled out letter of intent. We've gone through all of the important things that we need to have answers to. Hopefully by going through this, you get a general feel for some of the things that you can discuss with potential partners that might want to invest with you. And it helps you to kind of get through some of the questions. And hopefully this makes your whole conversation with a potential joint venture partner so much easier. Hopefully this helps you to be able to raise the capital you need, guys, in order to move forward in your real estate investments. And of course, if you need more help, that's what we're here for. Reach out. We, of course, have our Ignited program where we coach and mentor newbie investors, seasoned investors, anybody that's looking to scale their portfolio. So the link for that mentorship program is also in the description. So thanks for joining us, guys, and we'll see you in the next video.